In part 4 of our bank's lending rate system series, we will be discussing marginal cost of fund based lending rate system, the MCLR. Here we will see the structure and composition of MCLR and the special feature of MCLR which make it different from the earlier lending rate system. We will also see how the lending rates are revised under MCLR system. So because of these reasons, RBI decided to introduce the new lending rate in 2016, which is known as Marginal Cost of Funds Based Lending Rate System. This is also called as MCLR. So MCLR is the latest version of the lending rate system which has replaced the base rate of 2010. MCLR system was introduced in 2016 to encourage banks to accept the latest repo rate as promoted by RBI. Lending rates were expected to be more sensitive to the change in the policy rate under MCLR system. It aims at improving the monetary transmission and exploring linking of banks' lending rate directly to the market-determined benchmark. MCLR system focuses on transparency in financial institutions while determining the interest rate. It ensures availability of loan to the customer at fair rate and pass the benefit of reduced interest rate to the borrowers so that immediate effect of policy change must reach to the end user. Therefore, MCLR focuses on bringing equality in the system for both banks and the borrowers and thus improve growth and competitiveness among the banks and make win-win situation for everyone in the long run. Now let us find out the structure of MCLR. MCLR consists of four components: marginal cost of fund, negative carry on cash reserve ratio, operating cost, and tenure premium. Marginal cost of fund comprises of cost of borrowing and return on equity. Banks borrow from several sources including fixed deposit, current account, saving account, etc. So the rate of interest in these borrowing sources can be used for the calculation of marginal borrowing cost plus return on equity. Next is the negative carry on account of cash reserve ratio. We know that commercial banks have to keep certain amount of their deposit with the central bank in form of cash reserve ratio. So keeping the deposit with the central bank means commercial bank cannot use it for credit creation process, which is the main business of the bank to earn profit. So that is actually a cost to the banks. Then next is the operating cost. There are several expenses of the bank that includes raising funds, opening branches, paying salary to its employees, etc. And the fourth is the tenure premium. It is an additional slab of interest over the base rate based on the loan tenure. Now, among all the four components of MCLR, marginal cost of fund has a highest weightage while calculating MCLR. In this marginal cost of fund, cost of borrowing consists of 92% of weightage and return on equity consists of 8% weightage in calculation of the marginal cost of fund. As per RBI new guidelines, it is mandatory for all the banks to consider the repo while calculating MCLR with respect from 1st April 2016. Now let's take an example. If 1 year term deposit is 7%, then what would be the MCLR? So the MCLR will be 1 year term deposit, the 7% plus the CRR plus the operating cost plus the term premium. In the last slide, we have seen the composition of MCLR. Now let us find out why and when the lending rates are revised under MCLR. So basically, MCLR ensures that the lending rates are revised on the basis of the change in the CRR, tenure premium, operating cost, and marginal cost of fund. The marginal cost of fund depends upon the cost of borrowing and the return on equity. Cost of borrowing of the bank basically comprise of the repo rate, which is the rate at which RBI lends money to commercial bank, and the interest rate, the rate at which depositor lends money to commercial bank. So both repo and interest rate are the cost to the bank because these are the liabilities of the bank which has to be repaid back. Now let us find out what leads to the change in MCLR. Suppose if there is an increase in CRR, that means cash reserve ratio of the bank, that means CRR is inversely proportional to the sum of money with the bank to be used for lending or investment purposes. It is the amount of money which banks keep with central bank as a reserve. It is just like a token of safety and a tool for implementation of monetary policy, but it is the fact that CRR reduces the liquidity of the commercial bank. Commercial bank main business is credit creation, and credit creation is inversely related to CRR. So higher the CRR means higher the cost on the bank, and that will be responsible for increasing the MCLR. The next is the tenure premium. It arises from the loan commitment with a longer tenure. This means the length of loan is directly proportional to the amount of premium to be paid. So longer the tenure, higher the premium. Longer the tenure, higher the premium, and therefore higher the MCLR. Now comes to the operating cost. It is basically the cost on the banks in which is daily utility action of the bank, cost of providing the loan product, including cost of raising fund. It includes the daily utility action of the bank, while the bank always tries to cover its operational costs through its various charges. But there are many costs like insurance, etc., that cannot be covered by any other means. So if there is an increase in operating cost of the bank, it is definitely going to increase MCLR. Now, the most important factor which influences the MCLR is the marginal cost of fund. In fact, MCLR is mostly dependent upon the marginal cost of fund. It is the new mechanism based on marginal cost. Now, what is marginal cost of fund? It comprises of the cost of borrowing, which accounts for 92% weightage, and return on equity, which accounts for 8% weightage, deciding the marginal cost of fund. So the cost of borrowing plays a very important role in deciding the marginal cost of fund and therefore deciding the MCLR. So basically, this cost of borrowing is the borrowing of the bank from RBI at repo rate, the rate at which RBI lends money to commercial bank, and the borrowing from the depositor at the interest rate. Now suppose if RBI takes a decision to increase liquidity in the market under the liquidity adjustment facility. This facility was introduced by RBI in the year 2000 under Narasimha Rao Committee report, in which was the report on financial sector reforms, and the report basically, in that report, RBI started introducing the new method of liquidity management, that is liquidity adjustment facility, which comprise of repo and reverse repo, right? So what is if RBI decides to increase the liquidity in the market, it reduces the repo rate, that is the rate of lending to commercial bank. So the borrowing of the commercial bank will become cheaper. The cost of borrowing will become cheaper. It is definitely going to reduce the marginal cost of fund, and that in turn will reduce the MCLR. So any change in repo, either increase or decrease, brings change in the cost of the fund, and hence MCLR should be changed by the bank immediately. MCLR has been introduced to change banks to accept the latest repo rate as promoted by RBI. So MCLR is very sensitive to the change in repo rate. A marginal cost of fund will have a highest weightage in MCLR. So any change in repo will definitely going to have a high effect on MCLR. Therefore, MCLR is very closely linked with the repo rate. Thus, if there is any change in repo rate, it will have an impact on the borrowers who have borrowed from the bank on the floating rate of interest. Let us find out some more important features of MCLR which make it different from earlier lending rate system. Number one, the frequent adjustment. MCLR was introduced to enable faster transmission and frequent adjustments in lending rate with change in repo rate, so that the benefit of rate cut reach to the borrower without time lag. Loan linked under MCLR are home loan, some corporate loan, property loan, and the most important, floating rate loan, along with fixed rate loan up to a tenure of 3 years are linked under MCLR. Whereas loans which are not linked under MCLR are fixed rate loan with a tenure of more than 3 years, where banks will have discretion in pricing the product. Next, loan against consumer deposit, loan to bank employees, and special loan scheme by the government, where bank have to charge interest rate as per the scheme decided by the government, like Jan Dhan Yojana, are not linked under MCLR. MCLR is an internal benchmark used by the bank to fix the interest rate on floating rate loans based on the marginal cost of the fund of the bank. Another important feature is MCLR is applicable only on banks. It is not applicable on housing finance companies and non-bank financial companies, as they use their own internal benchmark to lend loan and not the MCLR. Tenure-based system, a very important feature of MCLR. Here, MCLR is basically a tenure-based benchmark instead of a single rate. This allows banks to more efficiently price loan at different tenure based on different MCLRs according to their funding composition and strategy. RBI directed bank to set at least 5 MCLR rates on tenure basis, that are overnight, 1 month, 3 months, 6 months, and 1 year. Besides these, banks are free to set rates for longer duration as well. It is mandatory for the bank to monthly review and publish MCLR 5 rates so that borrower can know the lending rates from the bank website and get the benefit of rate cut. Those borrowers who had already taken loan in the base rate system can get the benefit of rate cut by switching over to MCLR mode by paying some charges. Once the borrower opted for MCLR, switching back to base rate system is not allowed. So in this system, MCLR, bank cannot lend below minimum interest rate. Along with that, banks are forced to readjust their interest rate on monthly basis, which was not found in the base rate system, as base rate did not push bank to implement RBI rate cut immediately. And the total cost of bank lending in MCLR is MCLR plus the spread charge, which are the charge imposed by banks on the basis of CIBIL rating of the borrower. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.